Great. So here's the exercise set for chapter 3. First few are nice and easy. The first one says calculate per unit contribution margin. Sales price is $200 per unit. Variable costs are $65 per unit. So what is our contribution margin per unit? $135. Okay. Next one says sales price of $400 per unit. Variable cost $165. What is our contribution margin per unit? $235. Very good. And number 3, contribution margin per unit is 50. Selling price per unit is 150. So what is our contribution margin ratio? 0.33. Okay, 0.33. You take contribution margin per unit divided by sales price per unit. And of course that goes on infinitely, but usually you could just round off to 2 places after the decimal point. So 0.33 will do. Close enough for government work, as they say. And that's all we have to do for number 3. So let's move on to number 4. This product has a sales price of $250. It has a contribution margin per unit of 75. So what is our contribution margin ratio here? 0.3. Okay. So you could put 0.30 or 0.3 either way. Same difference. Any questions? Okay, we've already done number 5, right? So we can pass that and go on to number 6. Right, this one's a little bit longer. Okay, so we have a selling price of $400. Variable cost per unit, $160. Fixed costs are $36,000. First thing we have to figure out is break even in units. All right, okay.
In terms of the 0.3, will Canvas accept 0.3 or 0.30 either way?
Yep. In Canvas, 0.3 or 0.30 will both be considered the same. 30% would not, right? Because it can't take the percent sign. All right, so for number 6, how do we find break even in units? Per unit, correct. So total fixed cost of $36,000 divided by contribution margin per unit. And what is the contribution margin per unit for this exercise? You're on the right track. 240, right? We take the selling price minus the variable cost, and we get $240. So we take our fixed costs, divided by that $240 contribution margin per unit, and we need 150 units to break even. I'll put over here contribution margin per unit equals 240, just for reference. Okay, then we could simply take 150 units, multiply by the sales price to know our break even in dollars, right? So $60,000 of sales gets us to break even. Let's double check that. How do we double check it? What was the other way to calculate break even in dollars?
Fixed costs divided by the contribution margin ratio.
Okay, so fixed cost divided by contribution margin ratio. What is our contribution margin ratio? How can we calculate that? What was that, Rosalba? Okay. What was that, Zach?
Contribution margin divided by sales.
Okay. All right. So in this case, we have the per unit information. So I'm taking contribution margin. Oops, I did the wrong thing. Contribution margin per unit divided by sales price per unit. And we get 0.6, right? So that is our contribution margin ratio. And then we can divide that into our fixed expenses. 6,000 divided by 0.6, and we get $60,000. I don't know what I did last time, but yeah. So when I did it correctly, it came out correctly. Okay, so that confirms break even in dollars is correct. Any questions? All right, C, prepare a contribution margin income statement with 130 units. So we have $400 sales price times 130 units, 52,000. That's our revenue. Then we've got $160 variable cost per unit times 130 units. 20,800 of variable costs. How do we get our contribution margin? Sales minus variable costs gets us $31,200 of contribution margin. Fixed costs were up here, right? 36,000. Uh-oh, this is not looking good. The 31,200 minus 36,000, we have a loss of $4,800 or a net income of negative $4,800. You could say it either way. Since this says loss, I'm not going to put the negative sign because we already know it's a loss, and I'm just going to put $4,800. Joseph?
Not the quiz, that's one of the questions. We just put it as 49 right now.
So if the quiz says what was the amount of the loss, then you would put it as a positive number. If it asked what is the net income, then you'd have to put negative 4,800. You have to pay attention to the wording. Although I don't think that that question is going to come up for this exercise. Any other questions? Okay, so let's go on to D. And in D, it says they want a target profit of $48,000. So now what do we have to do to figure out how many units?
Fixed costs plus the desired margin divided by contribution of margin per unit.
Okay. When we do that, we get 350 units. If I did that right. Anybody got a different number? And if we want to convert that into dollars, we can multiply that by our sales price. 140,000. Or we could take our fixed costs plus our desired profit, divide it by what? The 0.6 contribution margin ratio. And we also get 140,000. Okay. F, we make a contribution margin income statement with $200,000 in sales revenue. So just like we saw before, we don't know how many units that is. How do we figure out how many units we sold if we brought in 200,000 in sales revenue? What do we have to divide by?
The selling price.
What?
The selling price.
The sales price. Okay, $400, right? So we take the total sales revenue divided by the sales price per unit, and we get 500 units. Okay, then we can multiply 500 units times the $160 variable cost per unit. So $80,000. Subtract that to get the contribution margin. Our fixed costs were 36,000. That has not changed. So let's go ahead and bring that down. And we get our net income by subtracting, right? Contribution margin minus fixed costs. Get an $84,000 net income. All right, any questions? Okay, 84,000, looks good. So when we increased sales from 130 units, 350 units, we went from losing $4,800 to an $84,000 profit. All right, so let's go on to number 7. Okay, number 7, purchasing a new machine. This new machine is going to reduce variable costs by 15 cents per unit, but it's going to increase our fixed costs. So sometimes companies invest in automation, equipment, something that's going to help them be hopefully more profitable. But that investment, not only do you have the initial capital expense, which we're not calculating here, but you might have some fixed costs to maintain that equipment. It might be a lease, or there might be other regular ongoing costs for that extra equipment. However, if it offsets your variable costs, if it reduces how much materials you need, if it reduces how much labor you need or your variable overhead, sometimes it's worth it to have the higher fixed costs and the lower variable costs. So that's what we're going to look at here. In this case, the variable costs are going down by 15 cents per unit, but the fixed costs are going up by $18,250 per year. Okay, here is a bunch of data for us. We have to figure out what's the impact on break even if they buy the new machinery. So a lot of this data have already been put in here for us. Now, with the old machine, we have 216,000 units sold. All we're changing here is fixed costs and variable costs. There's no change to the sales price and no change to how many units we're expecting to sell. Okay, we're only changing the costs. So with the new machine, we still have 216,000 units sold, and we still have a sales price of $215 per unit. Is there a change to variable cost? Yes, remember, that's going down by 15 cents per unit. So that brings it down from 175 to 160. So what is our new contribution margin per unit? 55 cents, right? We take the same price, but subtract the new variable costs, and we get a new contribution margin. Have our fixed costs change? Those were going to go up, right, by 18,250. So that brings us up, I believe, to $74,250. Correct?
Yes.
Okay. Okay, so now that we've updated the variable costs, the contribution margin per unit, and the fixed costs, now let's figure out what is our new break even in units. All right, so what do we do here?
Multiply the sales price by the units sold.
That would give us sales, so we will do that for down here.
Fixed cost divided by margin ratios.
Yes, so to get our break even in units, Christian is right, we take our fixed costs, divide by our contribution margin per unit. Right? And we need to sell 135,000 units to break even. Then we could just multiply that by the sales price per unit. And our break even in dollars is 290,250. Of course, I want to check that. We check that by dividing fixed cost by contribution margin ratio, right? And we get contribution margin ratio by taking contribution margin divided by sales price. Contribution margin divided by sales price, 0.2558. I'll divide that into our fixed costs. And we notice it's a little bit different because of rounding, but it's pretty close to the 290,250. Let's see which one's the official answer. I think it's the 290,250. Yes, so we'll go with that one because we know it's right, according to Canvas. Okay, so we filled out part A. Any questions there? So let's go to B. Again, sales. Yes, we can take units sold times the sales price per unit to get our sales. And guess what? It's the same that it was before because our number of units didn't change, and our sales price didn't change, right? So we got the same number. All right, although our variable costs did change, so our new variable cost per unit is $1.60 times the 216,000 units, 345,600. We'll subtract that from sales. 118,800. Does that look right to everybody? Okay, and then we said our fixed costs are now 74,250. And when we subtract that, we get 44,550 net income. Let's confirm. 44,550 looks good, okay. And for part C, now that we've done our analysis, are we better off with the new machine? Okay, it looks like it, right? Because we have a higher net income. So purchase the new machine would be our recommendation. Of course, there are other factors to consider, but just looking at the impact on profits, it does look like that would be a wise move. Any questions on number 7? All right then, number 8. Okay, so now we're going to do another sensitivity analysis similar to what we just did. This time though, there is a price increase of 8%. So last time we changed the costs, right? For our cost volume profit analysis, and now we are going to change the price. It says that if they increase their price by 18%, they believe they will not lose any customers, which is unusual. Usually when you raise your price, you start losing customers. But in this case, they're expecting sales to be the same in units. So what is their new break even in units and dollars with the new sales price? So again, the data here have been entered for us. Their analysis said that they're not going to lose any units of sales with the new price. So they're still going to sell 950 units. But the price is not going to be $125 any longer. So if we know the old price was $125 and it's going up 8%, how do we figure out the new price?
Multiply the current price by 8%.
Okay, we could take the old price, multiply by 8%,
Add that to
and add that to the original price, and we get $135. Okay, so that works. There is an easier way to do it.
By 1.08.
Exactly. So Ivan said we could take our original price, multiply by 1.08. If we multiply by 1, that's the $125, right? And then the 0.08 adds that 8% increase on top of it. So that gives us the same number. Okay, this makes things a little quicker. So the new sales price is $135. Our variable cost per unit, has that changed? The costs were the same, right? The only thing we're changing is the price. Does our contribution margin per unit change?
Yes.
It does, right? Because the contribution margin is the difference between the sales price and the variable costs. So the sales price went up $10. Guess what? The contribution margin per unit went up by $10. Okay. We have 23,000 in fixed costs. We can divide that by our new contribution margin per unit. And we get 621.62 units. So to get our fixed costs covered, we need to sell 621.62 units. Are we going to be able to find a customer that will purchase 0.62 of a unit? Probably not. I don't know what our product is, but there are a lot of products you can't really divide, right? Would you buy 0.6 of a couch? I don't think so, right? So what we do when you're trying to figure out the number of units to break even and you get something that's not a whole number, round it up. Okay, because if you round it down, even if it was like 621.1, normally we would round that down. But in this case, if you round it down and you only sold 621 units, you haven't quite broken even, right? So when it comes to break even in units, just always round up. So now we need 622 units, which is much better than the 852 we had before. So that 8% change in sales price means 230 fewer units to break even. And then if we just multiply that by our sales price of 135, oops, 83,970 is our break even in dollars. Let's do that the other way. We take our contribution margin per unit, divide it by our sales price per unit. That's 27.4% contribution margin ratio, right? Or so we take our fixed costs, divide it by 0.274. We get pretty much the same 83,900 something. I think the 83,970 is the official answer here, so let's double check it. Okay, 83,970. Okay.
Does that mean for these problems, we should probably stick to the first method rather than the second? This might be a little off in our answer.
Well, what I've done, whenever there is the potential of a rounding error from, for example, doing two different ways to calculate, because that's what's causing the difference. It's where the calculator's rounding things off or where we're rounding things off. So what I've done is in Canvas, I put a buffer, so it's not supposed to make a difference. You could do it either way and it would still count it as right. But if you ever think that you've been marked incorrect because of a rounding error, bring it to my attention, I'll check it out. But yeah, it seems like the textbook answers are based on number of units times the sales price per unit. It seems like that's really the way that they tend to go with. Any other questions? All right, well, let's knock a few more of these out. We're more than halfway through this exercise set, so that's good. Number 9 here, final replacement windows. Let's see, they think that if they sell if they invest $25,000 in advertising, they'll increase sales volume by 10,000 units. Okay, so let's look at what that will look like. This is the original data without the extra advertising. And we have to figure out with the extra advertising, how is that going to change things? So if they increase sales by 10,000 units, then instead of 6,500, there will be 16,500 units, right? The 16,500 units at the same sales price gets us 1,897,500. We have to, with our variable costs, also add that extra 10,000 units. So 16,500 at $69 each variable costs, we get 1,138,500. We can subtract and get our contribution margin. 759,000. Okay, it says here our fixed costs were 19,500, but that extra $25,000 in advertising, it's not a production cost. It's not a production cost, right? But it is a fixed cost. And the way we're doing this here is not separating out our administrative from our production costs. So we're going to go ahead and just add that $25,000 in fixed advertising costs to our previous fixed costs. Okay, so that'll give us 44,500, right, in fixed costs. And if we subtract that from our contribution margin, we get a net income of 714,500. Okay, now let's think about that. The previous net income was about 280,000. If these estimates are right, by spending just $25,000 in advertising, they can move that 280,000 to 714,000. Those must be some pretty effective ads, right?
Super Bowl.
I guess so. For $25,000, that would be like, what, a 3-second ad for the Super Bowl? Something like that? Is that?
Probably less than that.
I still can't hear you.
It's less than that.
It's less than that? You think so? Oh, fewer seconds than that?
Yeah.
Oh, okay, could be.
You just gotta talk really fast.
You're right, exactly. All right, let's try number 10. Oh, okay, now we haven't done this yet. So I'll be explaining this as we go through it. So far we've been dealing with companies that have one product. But most companies don't just have one product, right? So what do you do if you're trying to do this cost, volume, profit analysis for multiple products? Well, that's what we're going to learn now. And the concept is you have to start off by figuring out a ratio. If they have 3 different products, which ones are the most popular and which ones are the least popular, and then you come up with a ratio. So for example, In this example, the company has a ratio of 7 to 3 to 2. So for every 7 snowboards they sell 3 pairs of skis and 2 pairs of poles. Okay, so just looking at historical performance, they come up with that ratio. Then we can use that ratio to build what's called a composite unit. So one composite unit, in this case, would be 7 snowboards, 3 pairs of, skis, and 2 pairs of poles. And we'll call that one composite unit. Because then we could figure out what is the total price for one composite unit, what are the variable costs for one composite unit, and what's the contribution margin for one composite unit. And then we can take that to figure out how many composite units we need to break even. Once we know that, we can then extrapolate the data. So we could say number of composite units times 7, and we know how many snowboards we need to sell. Times 3, and we know how many sets of skis, and times 2, and we know how many poles. So you have to first kind of contract all the data into a composite unit, figure out how many composite units you need, and then you extrapolate it back out. So it's a multi-step process, but let's just go ahead and go through it here. All right, so the data have already been copied down here for us. We can see their snowboards each have a sales price of $320 and each have a variable cost of $170, which means each snowboard has a contribution margin per unit of $150. The skis each have a contribution margin of $175. That's for a pair of skis, obviously. And poles have a $30 contribution margin per pair of poles. It's hard to say. And they told us the ratio is 7 snowboards for every 3 pairs of skis and 2 pairs of poles. Okay. So now what we can do to get our contribution margin per composite unit is we multiply the contribution margin for each product times its number in the ratio. Okay, so 150 times 7 gives us 1,050. 175 times 3, oops, times 3 is 525. And 30 times 2 obviously is 60. Okay, so in one composite unit, we're going to have 1,050 of contribution margin coming from the snowboards. We'll have $525 of contribution margin coming from the skis, and $60 of contribution margin coming from the poles. And we can add that all together and get our contribution margin per composite unit, 1,635. Okay, is this making sense so far?
Yes.
Okay. Oh, is that all we have to do on that one? Okay. Oh, that's right. It continues on with the next exercise. I forgot. It's multiple exercises here for the same company. Okay, so now we know our contribution margin per composite unit. We could figure out our break even in composite units. So you see fixed costs divided by the contribution margin per composite unit. Here it says overall unit, but they mean composite unit. So they're just trying to confuse us with terminology. So we take our fixed costs of $196,200, divide it by this 1,635 we just came up with, because that's the contribution margin for a composite unit. And let's see what we get. We need 120 composite units to break even. Okay, if we sell 120 composite units, we'll break even. So now that we know that, this is where we can extrapolate it. Let's see. So we need 120 composite units. So in each case, we're going to multiply that by the number of units for that product type from the ratio, right? Like we know we need 7 snowboards in each composite unit. So we multiply it by 7 and we get 840. We need 3 pairs of skis in each composite unit. So we need 360 pairs of skis. We need 240 pairs of poles. Make sense? Okay, any questions? Got a question, Zay?
Yeah. Will we eventually have to figure out how to find what the ratio is, or will it always be given?
No, they'll tell us. I think in every case they tell us the ratio. Yeah. If you did have to figure it out, they would make it easy because that's not really the objective here. Okay. So then for number 12, we're going to take what we just calculated. How many snowboards we need to break even, plus how many skis, plus how many poles, right? Now the company might not exactly sell along its ratio, but in general it does, right? So this would be a pretty good estimate of how many of each type of product they'll need. So that means if they just sell 840 snowboards by itself, that's not enough to break even. They have to also sell the skis and the poles. So we're going to copy that down here. And then we're going to put in the sales price per product, which we can get here. Okay. So if we sell 840 snowboards at $320 each, 268 and 800. 360 skis at $400 each, 144,000. And 240 pairs of poles at $50 each is 12,000. Then we can add that all up and see what is the total revenue we would need to earn to break even. So I got 424,800. And let's see if that's right. Okay, there we go. All right, we just have a few exercises left. We don't have time today, unfortunately, so we'll tackle those on Thursday. All right, see you all then. Sure. Let me just stop the recording here.